Hey everyone, welcome to Cigars and Syndication. I'm Robbie Rogers, and I'm here with my co-host Jay, and we're passionate about cigars and real estate. And today we're going to talk about some different exit strategies to syndications.
Hey everyone, my name is Junaid Noor. Welcome to Cigars and Syndications. Like Robbie said, we are very passionate about cigars, and we're passionate about real estate too, but more so about cigars. And we will be talking about exit strategies in syndication and real estate and in different types of real estate that you own. But first, what are you smoking today, Robbie?
We are smoking a Flor de los Attilas from my father. It's a really good smoke. I'm getting a little peppery when I first lit it up, and it's a little bit on the milder side from what we've been smoking, and maybe just picking up a little leather.
Yeah, I like this cigar. It's smoking well. It's a little. I get some pepper. I get a little bitterness in my mouth, but it's not a bad cigar so far. I get a little bit of leather too. Not quite like the. I mean, this is by my father, but when you smoke the my father and you smoke the Le Bijou, it's just a completely different standard of a smoke. And hopefully this gets better as we smoke.
Yep, I'm hoping so. Today we're going to talk about some different exit strategies, and maybe compare it to or relate it to some of the situations that are going on in the market today, and what might be a good strategy for you.
Yeah. So when we talk about exit strategies in real estate, whether it's apartment complexes, any kind of real estate, single family homes, any investment properties, condos, whatever you have, there are really three main categories of exits. One is one is to just keep it. That's not really an exit, but you keep it, you hold it for the cash flow and the depreciation that you get from it. But the other exit is either you sell it, or you could do a 1031 exchange, or the other one is refinance it and take out the cash. So we'll talk about each topic one by one, and we'll get into some of the details. And feel free to leave us some comments on our YouTube channel, Albany Park Capital, or feel free to look up our website. Hit the resources tab, albanyparkcapital.com. We've got a lot of articles and a lot of free information.
Yeah, I mean, there's some really there's some people out there that are really creative, and they react to the market, and definitely impacts what they do to these properties right now. Maybe the especially in some of the real estate sections in the country, it's slowing down, and obviously interest rates are making an impact. And maybe they had to change maybe they bought the property with the intentions of selling it right away, and now hopefully their underwriting was done appropriately, and they can hold and cash flow it. So sometimes the decision is not necessarily what you want, but it's what you have to do to get through this high interest rate period.
Yeah. So in general, real estate makes money. But the thing with real estate is that real estate is normally a long-term asset. You have to be able to hold it for at least 5 years. The issue where people lose money on real estate is they underestimated remodeling costs, or they overestimated the resale value of the real estate, or they didn't plan for some other eventuality or some other emergency, and they have to sell at a fire sale. That's where people lose money on it. But that aside, assuming that you don't have to sell your real estate, this is a great time to hold, because as interest rates increase and as inflation is going down a little bit, but it's still at around 4%, asset values always go up with inflation. So, in an inflationary environment, you want to hold your assets. Rental values will go up, and because of that, the values of the assets will go up.
Right. So I mean, so you're hopefully breaking even or making a little money on the rent, and getting that 3, 4, 5% appreciation in property value, so that you're actually realizing some gains, even though it may not have been your plan ultimately.
So exit strategies go back to, what is your overall strategy, right? Hopefully you don't have to sell in a fire sale. So your overall strategy has to align with your real estate. You know, like if you have real estate, if you have any stocks, if you have investments in any other businesses. So all of that has to come together. And you should talk to your tax professional about this because they can help you align your strategies. Because stock portfolios and your ordinary income, whether it's W-2 or from a business, and your real estate passive investment income, they're all taxed differently, and they're all in different buckets, right? So it has to align with your overall strategy. So one of the strategies is I'm going to keep it and I'm going to get the cash flow from it. And then I will also be able to use the depreciation against other real estate investment or other passive investment that I have so that it evens out and I don't have to really pay taxes.
Well, that kind of leads up to the what you had mentioned earlier with the in regards to the 1031. You know, if taxes are one of your concerns, and you've invested and have a similar project that you can invest in again at a potential sale, taxes are a good strategy. And if you can save money and avoid some taxes by using a 1031, by all means.
So yeah, a 1031 strategy is a really good strategy, and in general, if you sell a property, you have the IRS requires that you identify a new property within 45 days, and then you close on that property within 180 days.
Yep, I think that's right.
And there are some ways you can try to extend those dates. You can delay the sale, or if once the property that you're selling is under contract, you can start looking for a new property right away, because usually when a property comes under contract, appraisal, financing, commercial properties will require environmental reports, all these other reports. Sometimes that takes 3 months. So you can actually add 3 months to that 45-day deadline because it's from the date of sale. And so the way it works is you sell your property. Let's say you bought your property for $100,000 and you sell it for $200,000. Now you have $100,000 gain. If you don't do anything, that gain gets taxed 15 or 20%, depending on your the type of property and the capital gains tax bracket you fall into. But if you do a 1031 exchange, that means you go and you buy another property for $200,000. So you bought the first one at 100, you sold this one for 200. You gotta buy at least a $200,000 property. So that $100,000 gain gets rolled into the $200,000, and so that's not taxable. And then it gets a little bit more complicated because any depreciation you took has to be recaptured. That gets rolled in as well. And so you get what's called a stepped up basis. So the basis of a property is whatever you paid for the property plus any depreciation recaptures or any capital gains recaptures. It gets a little bit complicated. And again, it's not something that you can pick up your TurboTax and try and figure it out on your own. And believe me, there are some people who try to do this. And I, being an accountant myself, being a CPA myself, told them, hey, get a tax advisor. It's not something you're going to be able to figure out yourself.
Yeah, and there's some syndicators out there that specialize in 1031s, and if that's your game, then I try to align with those groups, because timing is crucial. You have to have multiple opportunities in front of you, because 45 days in the real estate world is not a long time. 180 days to get it closed is not a long time. So you really need somebody that specializes in that and really understands it.
Yeah, and this is one of the strategies of building wealth is keep buying real estate, keep doing a 1031 exchange, and keep building up the gain in your property values without having to pay taxes. So this is a very good wealth preservation strategy.
Well, ultimately, and you may not know the answer, they may need to call their tax advisor. Let's say 4 projects down, you decide, do you only pay taxes based on the amount you pull out?
No. So there are There are a lot of different exit strategies outside of the 1031, but mainly the way people do it, and then it's going to get into it's going to get into estate planning, right? So if you have an LLC, you can start distributing the shares to your children. If you pass away, your children get that property with the stepped up basis as their basis, so they don't pay any taxes on it at all. Again, talk to your tax advisor. It becomes kind of complicated as it goes down, but once you sit down with your tax advisor, you can plan out a strategy that'll work really well for you and preserve wealth.
Well, I'm just going to talk a bit about this cigar again. I enjoy it. It's pretty mellow. Again, it's on the milder side. The peppery kind of faded, and I'm just kind of getting a nice mild woodsy flavor. It turned into a pretty good cigar.
Yeah, no, I agree with you. This is a sun-grown wrapper, and it's mellow. The bitterness is gone, which is good. And I am getting a little bit of wood, a little bit of leather, and it's not bad for a under $10 smoke.
Yeah, no, I agree. I mean, for the price point, this is an excellent smoke. I'm enjoying it, and I'm looking forward to finishing it.
So another exit strategy is obviously to sell it. And if you sell it without doing the 1031 exchange, then you're going to have to go ahead and you're going to wind up paying taxes on it. Capital gains taxes, capital gain taxes between 15 and 20%, depending on the length and whatever your other tax situation is. But another strategy that a lot of wealthy people use on real estate that has a lot of equity in it already, instead of selling it, they just refinance and take a loan against it. And so when you refinance it and you take a loan against it, well, that loan is not taxable. It's a loan. As long as the higher loan amounts are sustainable, or the cash flow from the property can sustain the higher loan amounts, it should work out fine. So it's a really good strategy that a lot of wealthy people use. They just take loans against their properties.
Yeah, no, I think that would be that's a really good strategy, and that's not one that I've not really got into the refinancing, but I know a lot of groups that did it very successfully, and they used that property and leveraged that property to buy multiple properties.
Yeah, and this might not be the best time because interest rates are high right now, 8.5%, almost 9% in some cases. But right now all indications are that the Fed, actually Goldman Sachs just came out with a report today indicating that they expect the Fed to start decreasing rates first quarter of next year.
I think we're all waiting for that.
We are all waiting for that. And so when the rates are back down to 3, 4, 5%, refinance and cash out is a great strategy, because ultimately what you're doing is, if your property is producing 10% and you can refinance at 3% and invest in multiple properties that produce 10%, why not?
Yeah, I know that, and I've read and I've talked to people in the industry, and there's some ownership groups that are struggling now. They put their underwriting together, looking to sell. Right, that was their single strategy. However, their PPMs were written, obviously where, they may need to hold it. They may need to hold it indefinitely. So, there's going to be some trying times. There's going to be some misdistributions. I mean, all the way from interest rate concerns to still trying to collect arrears from COVID.
Yes, and a lot of investors might be upset because they were promised that, or at least in the marketing material, they're promised that we would refinance and cash out, or we would sell the property within 3 years. But the reality of the matter is that you can't. This is not a good time to refinance and cash out, because your property probably won't sustain a much higher interest rate. If your initial interest rate was at 3.5 or 4% or even 5%, and now you need to refinance at 8.5, it'll be there are going to be very few properties that are going to be so well managed that they'll be able to sustain that much higher note.
Yeah, I've seen deals get quashed for a point. So to go from a 3 or 4 to a 7 or 8, I mean, it kills a lot of deals.
it'll be interesting to see what the banks will do to some of those properties. Will they? Because the banks are not in the business of owning property, right? They don't want the keys back. What they want to do is they want to collect their interest payments. So maybe the banks come up with something creative and say, okay, you know what? We'll still give you a 5-year balloon, but we're going to amortize it over 40 years instead of 20 years, just so that you can sustain the payments and hopefully the interest rate environment gets better. The rents go up higher, and we can keep getting our interest payments.
Yeah, we had a couple bank scares. I think a lot of the commercial loans and construction loans are regional. My hope is these guys get creative and restructure a lot of the deals.
Well, I think that's a lot of information for one episode. Again, talk to your tax advisor. People should really think about the different exit strategies. And exit strategy is something that you actually think about before you purchase, right? Before you get into an investment, you should know what that exit's going to be. And if you don't know, then you shouldn't be getting into that investment. That's my golden rule.
And we've done several podcasts. Jay's written some really good articles on albanyparkcapital.com. Go check them out, and you'll definitely educate yourself and maybe avoid a situation where you were expecting a sell and get a hold, or wanted a refi and they're still holding. Do your homework and make sure you know your partners.
Yeah, and I love to have checklists. Right before we end, I'm going to give everybody a homework assignment. Before you get into any kind of investment, have a checklist of all the due diligence that you're going to be doing. What the repair costs are going to be, what you expect to gain from it, what the depreciation is going to be, what the loan costs are going to be. But one of the items that you should have on that checklist is, how do I get out of this? What is my exit strategy? So whenever you're getting into an investment, make sure you have an exit strategy. And, we hope you enjoyed this podcast. Like Robbie said, we have a lot of resources available, free articles on albanyparkcapital.com. Hit the resources tab. Leave us some comments. If there's something you want us to talk about, if there's a cigar you want us to try out, we'd be happy to oblige.
Hey guys, thanks for joining us, and look forward to seeing you next time.